All right, welcome everyone. We'll give a few minutes. We've got the people signing on right now. All right, I think we've got a pretty good group. I'm just going to jump right into it. Thank you everyone for joining. I'm Mike Wiesenfarth. I'm the head of partnerships for Escalon. I'm sure most of you know it's Escalon's sponsored webinar series. We do this once a month. What we do is we feature a VC and walk through kind of some of the challenges of the VC climate. Really gearing content towards founders, sometimes towards investors as well. I Before we get started, I'll share a little bit about Escalon. I'll pass it around to a few of our sponsors, then introduce our guests. Like I said, Mike Wiesenfarth, head of partnerships for Escalon. Escalon is an outsourced CFO, fractional accounting. We do outsourced HR. We do taxes, basically everything that's essential business services for founders. So think of it, everything that's not building or selling your product. We can help out and support that. We typically work with companies, as soon as they incorporate up to, Series B, Series C. And hopefully this content is helpful for the audience. It is. I'll pass it around. We've got a few sponsors here. Garrison, why don't you start? This is Garrison with Cake Equity.
Hey, Mike. Mike, Brand, Team Escalon, thank you guys for allowing us to participate. Like Mike said, I'm Garrison Goins, and I head up U.S. partnerships here at Cake. Cake Equity, we're essentially transforming equity management for startups and are trusted by over 10,000 of them worldwide. Our platform, simplifies cap table management, effortlessly facilitates global stock grants, and streamlines the generation and e-signing of legal agreements and offer docs. So we're very user-friendly, very seamless experience that makes managing and understanding your equity easier and more affordable. We're committed to ensuring the teams are not just holders of equity, but actual knowledgeable participants in their company's growth. If you're interested in discovering how Cake can be useful to your team and empower and motivate your team using equity, feel free to reach out to me at garrison@cakeequity.com or visit us at cakeequity.com. Thanks.
Thank you, Garrison. We've got Ryan from GoGlobal, I believe. Ryan, are you able to get on? Ryan's having some tough technical difficulties. Travis, why don't you jump in? This is Travis with Gunderson.
Hey, everybody. Thanks, Escalon, for letting us participate, and thanks, Liv and Ted, for participating in the panel. I'm Travis Glock. I'm an attorney at Gunderson Dettmer. Gunderson was just named Law Firm of the Year or by PitchBook for the 10th year in a row. So that's not us putting the crowd on ourselves. That's PitchBook data. We do more deals every year, both company side and investor side, than any other law firm. We're really good at what we do. We intend to be company and founder friendly, whether that be, two founders in a garage with an idea or a serial founder looking to form their fifth company. We do everything from formation all the way to IPO. So, if you're looking at fundraising and you need an attorney to help you do that, happy to be a resource for you. Thanks.
Great. Thank you, Travis. And I see Ryan on. Ryan, I'll give you one more chance. If not, we'll just move along. Okay. All right. Ryan's having technical difficulties, but we'll just jump right into it. We've got two guests joining us. The first one I'll introduce is one of the consulting CFOs actually with Escalon. One of our senior CFOs that help startups, Ted Davis. And
nice
then
to see you.
yeah, thanks, Ted. And then also, probably the man of the hour. I apologize, Ted, but Liv Gheciu.
Thanks, Mike. Yeah, very kind of
Frazier
you.
Group. Sorry, Liv. So Ted, I'll turn it over to you to kind of drive the conversation.
Thank you very much. It's a pleasure to be here today, and I'm My name is Ted Davis, and I'm a fractional chief financial officer with Escalon. And I serve quite a few startups all the way up through their different cycles and paths in a number of different industries. I'm in the diversified vertical. And I have been doing startups all the way through IPOs for beyond 20 years at this point. So I have a good background in an understanding of the capital formation activity, and it's my pleasure today to be with Mr. Liv Gheciu, a partner from Frazier Group, which is located in Lehi, Utah. And Liv brings a wealth of experience and understanding as his role as a partner at Frazier Group. He has a background in designing and commercializing medical devices and collaborating with industry leaders. He's very well understood and equipped to identify and support high potential startups. And with his insights and practical knowledge, he is just, he comes out of the mechanical engineering school at the University of Utah, and he's deeply committed to nurturing and starting into the startup ecosystem, and also in mentoring next generation of leaders. So it's my pleasure today to introduce Liv Gheciu, and welcome, Liv.
Thanks, Ted. Really excited to be here, and hopefully I have something exciting, have something valuable to share with the audience today.
Well, I'm looking forward to starting off our conversation, and let me just ask, let's ask you to tell us about your path and what got you into venture capital.
Sure. So the first thing people notice when I start talking is my accent. It's a weird accent. So next question is where I'm from. So I'll get that out of the way. I grew up, and my name, of course, too, is a little bit strange. So I grew up in Romania. When I was in college in Romania, I got this job at Park City Mountain Resort. It was just a weird thing. My friend said, "Hey, let's go work at the ski resort in Utah." And I was like, what's Utah? And, so it was great. Like Park City just sponsored our visa. We came up here. I was able to buy a plane ticket for myself, and then I had $300 left in my pocket, and I just kind of left my family and my friends and just came to America, and just kind of made it work here. And as soon as I landed in Utah, I just fell in love with the place, and just fell in love with the mountains. And we have mountains in Romania, and they're beautiful, but here you can work all day, and then 15 minutes afterwards you can go in the mountains and just relax and enjoy nature. And so I love that. But anyway, so that's kind of how I started. And since I loved it so much, I decided to stay, and I transferred my credits to University of Utah, graduated with a mechanical engineering degree from there. But just one unique thing is, I noticed everybody I knew a lot of people from all over the world who were also working at Park City Mountain Resort as lift operators and ski instructors and whatnot. And everybody would kind of point out and complain about what's wrong with America and be like, hey, didn't like the food and didn't like this and that. And I was the exact opposite. I just loved everything about it. And so I kind of, just found out what foods I liked, and I really liked those foods, and I found out what I didn't like, and I just didn't order it. But I just loved being here and loved everything about it. And as far as venture capital goes, Utah is probably the coolest place and one of the best places to be in venture. Maybe California gets more deal flow, but there's also a lot more competition from investors, and it's just not as good of a ecosystem as Utah is. So I think we're really in the best place at the best time.
Well, very good. Let's talk a little bit about your company. You're a partner with Frazier Group, which is in Lehi. Tell us about the investment thesis and the overview of Frazier Group.
Yeah, so Frazier Group started back in 1997 in Utah. It started as an angel investor. My father-in-law, Scott, started it. A group of 21 angels kind of got together, and he was one of the co-founders of Utah Angels. And there was a lot of pent-up demand in Utah for venture capital. He was saying that in their first meeting, they had 3 companies present that later on they went to become billion-dollar companies. And they had Ancestry.com, the predecessor to Omniture, and True Hearing, True Vision. And so, there was just there wasn't any capital and just a lot of talent. And so that's kind of how we got started. And later on, it became a family office. So Scott brought on his son, David. A few years later, he brought me on as a partner, and then a couple years later, brought Kendall on, another son. So the 4 partners operate it as a fund now. The family office is about 50 or 60% of the capital, and limited partners are the remainder.
Okay. What kind of fund size and number of fund? You mentioned something about your funds, but what kind of fund size are you at this point?
So we deploy about 30 million a year.
Mhm.
We raise a new fund every year, and we deploy it within a 12-month period, which is a little bit unique. The reason is our cash flow, the family office's cash flow is lumpy. So sometimes we have no exits for a couple of years. So we take more money from limited partners. And sometimes we have, just like this year, we'll have 5 exits. And so we'll be a bigger chunk of the next year's fund.
Right.
Everything we do through the fund. So we don't pick and choose deals. It's all done through the fund. And our limited partners are just high net worth individuals from Utah. Most of it. We don't have um, any banks or anyway, it's just high net worth individuals.
Do you have an average check size that you like for your deals, and any geographical preferences or stages or industry specific, or are you industry specific for that matter? Or tell us a little bit about what your criteria for selection might be.
Yeah, we're industry agnostic. We do like B2B SaaS. We specialize in B2B SaaS, but that's very broad. So we don't really focus on any specific industry. The way we invest is we consider ourselves life cycle investors. So we'll start investing in a company when it's at the pre-seed or seed stage, when they're early on, early revenue, like 100,000 to $1 million in annual revenue when we do our first check. But then we follow on heavily throughout the entire life cycle of the company. That's really probably the most unique thing about us as a fund. Most funds kind of put themselves in a bucket, and they say, okay, we're a seed fund or we're a Series A fund. We're a life cycle fund. So our first check will be the smallest check we put in a successful company.
Very good. Okay.
And as far as the check size, it really depends on the company size. So if the company we invest in is a Series A company, we might put 2 million in that, or 3 million. And if it's pre-seed, we might do 500,000 to $1 million.
I understand. Yeah, very good. Could you tell us a little bit about your decision making and your due diligence process for a company to qualify for your support?
Yeah. So as far as due diligence, it really depends on the stage of the company. Early on, when a company is pre-seed, we do less due diligence. It's just really lean, really quick decision making. We, typically we'll give you an answer within a week. We'll maybe make a couple of phone calls to your clients. We'll look at the pipeline. We'll do a pipeline review. And just meet the team basically, and kind of understand the product and the market. Since we're not focused on any specific markets, we're not experts on any market either. So we're kind of becoming experts as we talk to the company. Companies that are later on, like Series A or seed and Series A, there's a lot more data to look at. And so we look at more financials, and there's a lot of the SaaS metrics that we like to look at and dig into churn and all these metrics because there's more data to look at.
Very good. Do you have any equity ownership minimums?
Yeah, so as I was saying, we're life cycle investors, and so what makes our model work is being a major investor, and so we won't put money into a company if we think we're not going to have follow-on investing, um, because that's how we make our money. We found through like I said, we started investing in 1997. That group of 20 angels, they actually had a reunion a few years later, and so those were, just people investing their own money into the same companies. And there are lots of good companies there. They would all look at the same deals. They would talk about them. And it turned out after many years that only 3 of those angel investors went on to become successful venture capital investors. A lot of them were very successful people. One of them started Lucid, and another one started Bamboo HR. So they're all really successful people, but they weren't successful per se in venture capital. And so what we found is that the first check you write, you're right about 10% of the time you pick the right company. And so that's the most risky check you write. But once you've gotten to know the company, and you kind of start to find out which ones of those first checks was in a company that's actually successful, you have to do follow-on investing to kind of concentrate in the winners. And that's our model. And to make that work, we need to become, in our first check, we need to be big enough that we have major investor rights. And for us, that means have access to information. So whether it's a board seat or a board observer seat, or and have the contractual rights to follow on in future rounds, to participate in the A, B, C, D rounds, and also to buy secondaries and have a right of first refusal for the pre and secondary transactions later on when the companies get larger.
Yes. Would
And
you
so,
describe, I'm sorry, I didn't mean to interrupt. Go ahead. Please continue.
yeah, so to become a major investor, I think you have to have I don't know, 5% of the company or something like that. It just kind of changes with every deal, but that's really what the minimum is being major investors.
Very good. Do you have a basically an internal investment pace that you like to adhere to within Frazier to bring on new companies? Or is it pretty much just
No,
basically, go
it
ahead.
really depends on the market and the conditions. So for example, in 2023, first half of the year, we didn't write a new check to any new companies. There just wasn't any attractive deals. And everything we've done was in the second half of that year. And then we wrote, 7 checks or 7 new companies. So it really just depends. We're flexible. We just invest in what we believe is the best opportunity out there.
And speaking of that, let me just ask you, what is your current view of the state of the market? What are you seeing for the future, and how are you advising your companies?
Yeah, it's definitely warming up. Like I said, in 2023 was really tough. We didn't see many deals at all, not many deals worth doing. Um, and so we didn't do any deals. And now it seems like things are picking up, and we're seeing deals, and we're investing in companies. Of course, AI is big, and we're excited about that. So I think things are looking up. I think the reason why there's been kind of a drought is I attribute that to the high interest rates. Money isn't free anymore, and so investors are just kind of looking at deals, and you can't get the same multiple on revenue and the same high valuations as we used to have a couple of years ago. And so it's just kind of a tougher market, and there haven't been many exits. And historically in Utah, a lot of the angel and pre-seed capital came from harvested, entrepreneurs. And since there haven't been many IPOs and exits, there just hasn't been as much money to put back into the ecosystem. And that's kind of my theory.
Understand. Is that going to loosen up a little bit as we go forward, or is it going to be an election year and we're going to wait and see?
I sure hope that interest rates go down, we'll start to see more deals, and people will start spending more money.
I
Put more money
understand.
in companies.
We're going to
Yeah.
transition now and basically talk a little bit more about fundraising. But before we do that, we want to ask our attendees specifically to, if they will go to the chat box and just give us an idea. We'd like to know specifically, how much time to spend on this particular topic of fundraising, and we want to give certainly some valuable information in our webinar today. If you could basically just give us a little bit of an idea through the chat box if you're actively fundraising. Just drop us a line in the chat box. We'd like to know that, and maybe how much you're looking for at this point, and any of the challenges that you've experienced in the fundraising arena at this point, or any other questions that you'd like to raise. If you could take just a couple of minutes and put those answers in the chat box, that will help us tremendously in knowing which way we want to go ahead and take this next segment of our presentation. Okay, so yes, yes from James Benson, and Raul is saying yes, pre-seed 3 million. Okay, maybe that's 300 million. Okay. Fundraising. Okay, very good. Let's go ahead and Abacus Exchange, FinTech. Okay. Okay. Seed round 2 million. Okay, very good. Thank you very much for that feedback. This all looks like it's well within your funding ranges and so forth, Liv, in this situation. So let's talk a little bit about how important is it in meeting your investment management group, okay, your founders and so forth in person. Is that something that you do as a mandatory step in your due diligence? And what basically, how do you get to know those founders and management teams?
Yeah, I mean, it's not mandatory. We like to start with an introduction call or Zoom meeting just to kind of make sure we're a right fit. But absolutely, we like to meet the founders in person. I think the relationship we build with the company is very important to us. Like I said, we strive to, we put in a $500,000 check, and then over the next 6 or 7 years, we want to put in $20 million in that company. And once, when a company starts doing really well, it's hard to put more money to work because you get a VC from California who wants 30 million out of a 40 million round, and there's just no room for small investors like us. So we feel like the relationship is hugely valuable, and that's the only way we can put more money to work within those companies that do well, is by having a good relationship with the founders. But if a company is geographically not in Utah, it's not a mandatory thing. We'll put money. We'll invest in companies even if we don't meet founders in person.
So you're not geo-specific, as you mentioned earlier, but so you are flexible with regard to that. Let me just ask you an important question. I think that all of our attendees would like to know. What are some, in your opinion, Liv, what are some of the key mistakes that you see founders make when it comes to fundraising? Where do they kind of blunder a bit, stub their toe?
Well, I think maybe not talking to enough VCs or investors is one mistake, is not creating enough competition between funding sources. And one thing I'd add is, to me, I think differently of a company that comes to me directly versus through a warm introduction. I think warm introductions are very, very important. So if you're going to go talk to a VC, look in your LinkedIn and see who do you know who knows, one of the principals in that VC, and try to get a warm introduction. Or if you've pitched one or two VCs and you're getting good vibes from them, ask them for introductions to, you know, who you should talk to. Because VCs, they like to collaborate and they like to syndicate deals. And also in your interest is to kind of create, like I said, some competition between them and make them make decisions faster and try to get in on the deal before they lose out.
Yeah. Specifically, what kinds of companies are you looking to invest in at this point today? Or do you have a kind of an area? You mentioned SaaS, I think was
Yeah.
what you talked about. Are there others?
Yeah, so the reason we like you know, B2B or enterprise SaaS is it's tough to be in you know, consumer products or SMB. If you're serving SMBs, it's just a really tough you know, customer. Basically, you're not just, even if you have a great product or service you're providing, your customers go out of business all the time, and so you're just losing a lot. Whereas with enterprise, they're just sticky. It's a harder nut to crack, but once you do, it's just stickier and harder to dislodge a good product and a good company.
Absolutely.
So that's
I think one of the things that one of our viewers would like to know is specifically, do you basically lead only in your work, or do you also syndicate? I think you mentioned syndication.
we often lead. And just as often we follow and syndicate and follow behind other VCs. So we like to have other VCs along with us. It's always, you know, it's better for everybody. It's better for the company to have them have multiple deep pockets around the table that can support the company. You know, maybe almost all companies pivot, and so there's always lows and there's always highs, and so having more VCs invested in the company is always better. And so for us as well, because then, you know, we don't feel like, if we feel like the company can't attract investments from other investors, we would probably not invest in it either. So we
Yeah.
like to have syndicates too.
You mentioned that you're not geo-fenced to Utah, but do you do international investments as well? Do you go outside the United States?
No, we don't do international. We do about 80% of what we do is in Utah, just because there's so much deal flow and such high quality deals here.
Mm-hmm.
But we are open um to other geographies. We're open to you know, adjacent states and even others. We're not really landlocked here.
Okay, very good. Let me ask you kind of a very professional question, I think, at this point in time regarding your background and what you've been doing. What gets you really excited about a new deal?
Well, it's really exciting when a company finds a niche, a small market that they can dominate. So basically, you know, we believe competition kills profit. So it's tough to build something and make it successful within a competitive market. And so whenever we see something that can be, you know, a small, maybe creating a new category or just having a really strong moat, something that's unique and hasn't been done before, that's really exciting to us.
Okay, very good. Is there anything in particular that is really your favorite in terms of what you like about the process, the capital formation process?
Oh, no, I guess I guess I need to mention AI now, because AI, everybody talks about AI and AI is everything. We're excited about AI, so I'll give you that kind of, that same principle of competition applies there. So the way we think about AI is companies need to own their customers, and if they don't, if they're just a shell for ChatGPT or maybe something, or just a tool that you use on Salesforce data, that's not as exciting. But We recently invested in a company here in Utah, and they're taking AI and making it more usable. It's called enhanced AI, and they basically it allows you to fine tune and add tools, and it's all no code, and so it's cool because of that. It adds real value to something that, frankly, it's not very user friendly right now for businesses to go and take AI and implement it within their own workflows. And so this company makes it easy for them to do that, and we like that.
Okay. We are also in a situation where with that innovation, we're kind of looking to see exactly what kind of regulation comes along with it, I'm sure. Yeah. So it's kind of a situation of watch and see how it unfolds. Let's move into the post-investment arena just for a second. How do you support your portfolio companies once you've written your checks and you're in different rounds? How do you support them? Do you take a position in management? Do you are on the board? How do you handle it?
We take a board position very often. It's not, it's not to control the company in any way. We feel like the founding team, they're the experts, and they ought to run their company the way they want to run it. And oftentimes investors kind of get in the way. Founders sometimes feel like if you've taken the money from an investor, you kind of owe them a trajectory, something that you promised. Maybe you promised to hire 15 developers with that money, and things change all the time. And that's the greatest asset of a startup, is how fast they can fail and pivot and adapt and change. And so we don't want to take that away, and we don't want to be in the way of that. We want the companies to, fail fast and pivot and find out what's not right, and just change. And if they don't need 15, and they can do everything they want to do with 5 developers, they shouldn't hire 15 just because they promised that to a VC. So
Right.
so we try to take a back seat. We want to be there to help in any way we can. We have a portfolio of 50 companies that are great. So if you're looking for, and there's, people exiting all the time, and there's high quality employees that are always, looking for work, and we can help you find really valuable individuals. But we try not to get in the way too much.
Very good. I've got a couple of chat questions that are coming in through Mike Weisenfarth at this point in time. Mike, would you like to jump in and ask those questions so we can get some of our attendees' questions answered at this point in time?
Yeah, let me jump in with a couple, Liv, and hopefully this isn't too disruptive. But there's a question in the chat that's about QSBS. Is that, I assume, with when you guys invest, that's something that you guys value quite a bit, but maybe you can just share a little bit more about your perspective there, complicated situations, anything like that.
Yeah, that's hugely valuable. QSBS, qualified small business stock. It's a tax exemption, and we absolutely love it. So basically, when you put money into a company with under $50 million in assets, basically you can write off a lot of the upside. So, I forget what it is, but something like 20 million, or anyway, it's huge. And so we definitely pay attention to that. That's something we absolutely love, and we take advantage of.
Got it. Okay. I mean, makes sense, right? Like it's no brainer if you can qualify. Do you guys also invest in safes? Is that fairly common?
Yeah, we invest in safes. The thing that I would say with any kind of bridge or safe note is we shy away from uncapped notes and uncapped safes. We feel like, if we're going to give you the money to grow, we want that money to convert at a valuation that's fair at the time when you take the
Right.
money, and not, 2 years later, after you use the money to grow. And then so that's really the only difference, that maybe it's misunderstood sometimes. They think, oh, we'll give you a 20% off the next round. But if that round happens 2 years from now, that doesn't mean much. You know, we kind of want our money to be working for us.
Right. Good point.
Yeah.
So you can structure that. I think you can structure safes that sort of have time.
Absolutely. Yeah, absolutely.
Right, time targets. Okay, awesome. And then I've got a couple more. I know you went over types of companies you guys typically invest in. As you might be helpful for founders that are listening. Like a lot of people, the way that you decide what you're calling the round that you're raising, I feel like is getting a lot more broad than it used to be. So how do you think like, oh, I'm raising a pre-seed versus I'm raising a seed round? You know, I'd love to hear one, is there key differences you look for that differentiate the two? If someone's representing themselves in a way that you think they should be one or the other, you know, what's your opinion on that?
Right. Yeah, that changes all the time, and it's changed. Not only that, but it's changing already. So, you know, when we started, a Series A was like $1 million in revenue. Um, Not when we started in 1997, but like maybe like 5 years ago, a Series A was $1 million in revenue. Now, Series A seems like it's a company with 15 or 20 million in revenue. So it changes all the time. The way I categorize it is pre-seed or angel is a company that has maybe an idea, or their angel would be like pre-product, maybe in beta. Pre-seed would be maybe they have very early revenue, like maybe some, you know, pilots going on, but not real, you know, maybe like 100,000 or 200,000 annualized revenue is, in my mind, is a pre-seed company. And then it just kind of goes up from there. Like a seed company might be 500 to $1 million in revenue, and like I said, a Series A might be 10 million.
Okay.
That's kind of how I categorize it, but it doesn't really matter so much what you call it.
Right.
Yeah.
Okay. Okay. And then could I ask? Yeah, go for it, Ted.
No, go ahead. You have one more question. Go ahead.
I did have one more. This is actually a personal question, Liv. When you guys do the decision-making process internally, what does that look like? Like, what should founders expect? They walk away from a pitch with you. Is it a team decision? Is it voting? How do you guys decide?
Yeah, it's a team decision. So we have 4 partners. We look at every single deal together. First, you know, you'd talk to one of us, and if we decide, hey, this is worthwhile for the 4 partners to look at, we'll probably have a follow-on meeting where you meet all of us and we meet your whole team, and then we just basically go through internally and we look at everything we know about the company and the industry and the market, and we vote on it. And yeah, so that's how we do it.
Is there a timeline turnaround on average?
Yeah, we're really quick, like a couple of weeks tops. I mean, if we're not actively looking at a business, yeah, we probably wouldn't do it. But yeah, within 2 weeks we can make a decision. We're very fast.
Very good. Thanks, Mike. Appreciate you
Yeah.
coming in with those questions from the chat box. You know, let me go ahead and continue on this post-investment path at this point in time, because I think our viewers would like to know just exactly what kind of interaction they could anticipate in dealing with your company. How often do you communicate with your clients, with your companies?
You know, we only, I mean, at the minimum once a quarter we want to get an update from the company. But what we ask is, so we're very, especially for follow-on checks, we're very quick to make those decisions. So once we know the company and we know a team and we absolutely love what they do, we're very quick to write checks, follow-on checks. So if the company needs a little bit of capital to get them to the next round, for us, it's a really quick conversation. And we want to know about it. We want to know that they could put more money to use, because that means they can grow faster. So you know, we want to be open. We try to keep a really close relationship with the company. You know, we take our companies to Lake Powell once a year, and you know, just try to be as friendly and helpful as we can.
Get to know them very well. Do you engage in bridge capital with your companies, and how often do you do that, and what's your criteria for bridge investment?
Yeah, so sometimes, like I said, it makes sense to raise a little bit of money from insiders at a maybe a lower valuation just to get you to that next round. And maybe, you can double your revenue. And when you go out to a broader market and market yourself to, VCs from California, then you can get a much higher valuation. And so you can take a small, and we're very open to writing smaller checks to get you through the next phase. And we'll participate in bridge rounds as a first check too. We don't, like I said, it doesn't make a lot of sense. I mean, if you're going to put a cap on it, it almost doesn't matter if it's a bridge or a price round. As long as it has a valuation, then it's almost the same for us.
You mentioned that in your selection process, that not every company that you select is basically a successful activity. So obviously that's understandable. But in your mind at this point in time, what do successful founders do really well to facilitate your investment advice and facilitate their growth? Okay, what are some common characteristics that they should do really well for you, or you should see?
There's a couple of there's one thing I noticed that's common amongst successful CEOs. We've invested in a company recently called Parallel, and the founder Renato, he's just really impressive. He's always on the call with somebody. He's just really fast and agile and talks to a lot of people and pitches twice as many VCs and just is always like go, 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 super active, always busy. And so that was really impressive to us. Because he does that, he has the opportunity to refine his pitch, because twice as many people hear his pitch and give him feedback. And so he can quickly change and adapt. And I noticed that with another CEO of the CEO of Filevine. We took him to Lake Powell last year, and we were on a boat on Lake Powell, and he was almost always working. Like, he was just on conference calls all the time. We were out wakeboarding, and he was just working and always doing stuff. And so that's very impressive. And those are two successful stories. So maybe it's just bias, but that's one thing I noticed.
It's a very interesting observation that you make about the drive of the ownership, okay, and how hard they work. I don't think anybody really understands what it takes to totally, if they haven't done it before, starting a company is not an easy activity, especially if they're starting from day one and they put $1 in. It's out of their wallet, so to speak, and they live and breathe and go down the road in those situations, taking all of the risks and the bumps and so forth, and then finally get to an area of semi-critical mass. Okay, starting the revenue streams and so forth, and that's fun to watch. It really is, and I'm sure that's one of the things that you're looking for as you take a look at their path. What path have they gone down, and have they had some bumps along the way, and what did they learn from it? So,
right, that's exactly right.
Liv, let me ask you specifically, how does someone contact you? How do we get in touch with you? How do our viewers get in touch with you to follow on from this particular webinar presentation?
Yeah, so email is the best way. It's maybe you can post that, but it's liv@frazier.group.
Yeah, that's spelled L-I-V for those of you that are taking notes. Okay.
Yeah,
at fraziergroup.com.
Frazier.group.
Yeah.
And so, you can hit me up on LinkedIn, email me. That's probably the best way to get a hold of me on first time, and then obviously we'll just take it from there. But I'd love to meet a lot of you on the chat, and kind of, if you have more questions, I'd love to talk to you and meet you in person.
Very good. Mike, I think you had a couple of more questions from the chat box. Do you want to go ahead and bring those in now?
Yes, let me pull them up. I just got distracted. So one question that's come up, are there, just thinking of, and Liv, let us know, I know you have a hard stop coming up, but industries that you're avoiding. Is there anything that a narrative there where, hey, we definitely won't look at a company like this? I think you mentioned construction being one.
Oh man, I don't know. I think there's opportunities in every industry, honestly. I don't wanna say any, I don't know. Yeah, I don't think there's any industry we would absolutely not do, but I mean, if something makes sense, if it's a good business fundamentals, I think we would do it. Yeah.
Okay, great. And then just do you have any more general tips for founders as they think about fundraising? You know, are there examples of really prepared founders you've met with or who have pitched you, or less prepared founders that are sort of, you know, common mistakes people make?
Um, yeah, I mean, um, I don't know that I think just being really upfront with what you have and what you don't have, you know, that's always good. Just being honest with what your company is and is not. I know it's tough when you're so early on. They're just, you know, you need so much capital, and it's hard to get capital, especially when you don't have anything to go off of. And so um it's tough when like you find out that they maybe made up some data or have been haven't been forthcoming about you know, some of their clients, or maybe they call uh a friend a client, but they're not really clients. And so just being forthcoming and open about the challenges and what the business is and is not, I think that's important.
Great, awesome. And that does actually cover a lot of like everything in the Q&A section, specifically Ted. So
Yeah, I
maybe
think
we
it pretty
wrap
much
things.
does. Yeah, let me just go ahead and say, uh, we'll go ahead and really take any additional questions that you might have in this situation. But I want to take an opportunity to thank you, Lee, for your participation today. It's been just great. It really has. We really appreciate having you here on the program, and thank you so much. We know you got to catch a plane in this situation. I think you told me you were at the airport. Is that where you are?
I'm in the airport parking lot, yeah. So I just as
Okay.
soon as we close here, I'll run to security.
Okay, well, we wanted to basically thank you once again and turn the time back over to Mike. Mike has, I think, a presentation from one of our sponsors at this point in time, and then we'll wrap up. So thank you very much for your presentation today. We've really enjoyed visiting with you, and back to you, Mike.
Yeah, thank you so much. Also, Ted, it was great chatting with you, and thanks to all the listeners, and please get in touch with me. I think we spend about 80% of our time is spent trying to find new deals. That's the hardest thing we do. So this is huge for us, and thanks Escalon for putting this together and everything that you do. So this is awesome.
All right, thank you. Back to you, Mike.
Great. Thank you, Liv. Thank you, Ted. We will give a couple minutes. We had missed Ryan, if you want to jump in. We didn't get the Go Global overview, and then we will wrap things up. Ryan?
There
Ryan
he,
cannot hear.
there he is. I see him up there. Are you there, Ryan? Okay, you want to go ahead? Are you muted? Mike, he's not coming across
Oh,
with any
we're not
audio.
getting anything. I'll give Ryan a quick breakdown. Ryan is with Go Global. Go Global is an international expansion platform, from recruiting to contractor payments to employers of record services. They help companies expand to new markets around the globe. So think of them if you're firing or hiring new employees in different countries where you don't have previous establishments. Reach out to Ryan and his team at Go Global, and they can get you set up in a compliant way. And with that, I will leave us all. Thanks everyone for joining again. Thank you, Ted. Thank you, Liv. Thank you to our partners, and we will see you all next time.
Thanks, guys.
Thank you.